Earlier this month, CBRE released the results of their 2023 U.S. investor and lender intention surveys, which polled over 180 investment firms, including more than 50% of respondents managing over $5 billion of commercial real estate assets, and life insurance companies, banks, and debt funds, all doing over $1 billion of origination volume each and every year. For similar reasons to why I like to dig into the annual ULI and PwC Emerging Trends report each year, these kinds of surveys allow you to get an inside look into the thought process of some of the biggest players and capital allocators throughout the entire industry, who also often have the most access to information that drives their decisions. But even though these reports can be insightful, these are also not all that easy to interpret if you haven't been in the industry for a while. So to help you get a sense of what these surveys are saying and what these results might mean for your own real estate career, in this video, I want to summarize some of the most notable insights that I took away from reading these reports and the implications for real estate investors and investment professionals looking to break into the industry in 2023. So the first thing I found interesting, but not all that surprising in these reports, is that purchase and sale activity is expected to slow down significantly this year, both on the buyer and seller sides of the equation. Almost 60% of respondents plan to buy less than they did in 2022, with almost 50% of those surveyed planning to decrease acquisition volume by more than 10% in 2023, and only about 15% of respondents in total had the intention to buy more real estate than they did in the previous calendar year. And on the sell side of things, investors also reported planning for significantly fewer dispositions, with about 44% of those surveyed expecting to sell less than they did in 2022, and over 15% of respondents having no intentions to sell any assets at all in the current market environment. On the buy side, it's clear that investors see continued macroeconomic challenges ahead, including inflation and interest rate hikes as material headwinds to both NOI growth and increases in property valuations, and many firms are betting that the worst is yet to come and that distress has yet to hit the market in any meaningful way. Most property owners also have extremely little incentive to sell deals in this environment, again, unless the property's operations can't support the property's debt service due to material increases in a floating interest rate over the last 12 months, or an upcoming loan maturity that can't be refinanced at today's valuations. Ultimately, all signs are pointing to significantly lower transaction volume overall in 2023, which is helpful to keep in mind, especially if you're in the process of a job search and deciding whether to target larger, more established organizations that can fund operations exclusively through asset management fee income, construction management fee income, or income from in-house property management that isn't dependent on deal activity, or to target more transaction-dependent companies like brokerage firms that rely on investment sales and loan originations to earn commissions, or startup private equity firms that rely on acquisition fees, disposition fees, and promoted interest just to keep the lights on. There are pros and cons to each of these directions, and just because the bigger company path is often going to be the safer route in this type of a scenario, that doesn't automatically mean that it's going to be the right choice for you, but this is something to think about as you're planning out next steps in 2023. Now, the next thing I found interesting in the investor survey specifically was the attractiveness ranking of alternative asset classes and what this might be saying about investor outlook as a whole. Debt was by far the most desirable alternative category in the report, which is very likely due to yields on these investments climbing substantially in 2022, and build-to-rent housing, life science properties, self-storage, and affordable housing all came in the top tier of this list. Each of these sectors tend to be somewhat recession resistant or even benefit from a recessionary environment, with demand for build-to-rent residential product often increasing as wages decrease, demand for self-storage product often increasing as people downsize their homes and move into smaller spaces or double up with friends and family, and demand for affordable housing often increasing as a result of an increased number of individuals and families that qualify for these units when unemployment spikes. These alternative sectors have actually become some of the most attractive asset classes across the entire industry right now, with traditional property types like multifamily, industrial, retail, office, and hotels all facing challenges for several different reasons. For multifamily and industrial, two of the hottest product types during the last cycle, these sectors are both starting to see significant supply issues in many markets across the country, which is beginning to slow and even reverse the massive increases in rental rates we've seen since the start of 2020. And for retail, office, and hospitality assets, these product types are also running into some major headwinds, with a continued rise in e-commerce and weakening consumer confidence posing very real threats to retail sales this year, hotel performance being at the whims of demand for travel, which is one of the first things to be cut in a downturn by both businesses and individuals, and a significant amount of oversupply of functionally obsolete office product that's putting a lot of downward pressure on rents in most markets across the country. Of the investors surveyed in the report, more than 40% expected discounts of 10% or more for all product types in 2023, with roughly 25% of respondents predicting a 30% plus discount on stabilized Class A office buildings and shopping malls, and over 50% of respondents predicting a 30% plus discount on value-add Class A office buildings. All of this is to say that specializing in a niche product type right now might be one of the best strategies for job security in 2023. And if you're still undecided on your career path and you have an interest in working for a debt fund or want to enter the build-to-rent residential, self-storage, affordable housing, or life sciences sectors, these could all be paths worth exploring as the market continues to settle. Now, the last major thing that stood out to me in these reports that will very likely put even more downward pressure on transaction activity and pricing this year is the significantly more conservative approach that lenders are planning to take in 2023. 86% of lenders surveyed said they plan to make more conservative underwriting assumptions this year, with 24% of respondents saying they plan to adjust cap rate assumptions, 20% saying they plan to adjust exit strategy assumptions, and 17% saying they plan to adjust debt yield requirements, with 48% of all lenders surveyed expecting origination activity to be more than 10% lower than in 2022. But even though these are all helpful data points, what I thought was the most interesting here is that the vast majority of lenders surveyed also believed that inflation and the 10-year US Treasury rate would peak in the first half of 2023, and when asked if they thought they would originate more fixed or floating rate loans in the new year, 57% of respondents said they plan to issue more floating rate debt than fixed rate loans, and 57% of those surveyed also reported that their preferred loan term would be for 5 years or less. And with lenders planning to issue more floating rate short-term loans, this tells me that the borrowers that these lenders are working with are very likely making similar assumptions about inflation and interest rates, pricing in a decline in rates over the next 12 to 18 months, and looking at floating rate options to take advantage of potential rate cuts that might be made in the future, or looking at fixed rate product today that they can also get out of in the near term if rates do drop materially in the next 1 to 2 years. Again, this all leads back to subdued transaction volume in 2023, since if investors believe that interest rates will peak in Q2 and start to decline towards the end of the year, sellers are likely going to wait to transact until that decline happens, and buyers are likely going to wait to make offers until they can finance their acquisitions at a more attractive cost of capital. All of this is to say that if you're working in lending right now or thinking about working for for a traditional lender in the future, this might be a slow year from a transaction volume perspective, but if this is the part of the business that you want to be in long term, and you're able to land a role on a top mortgage brokerage team or loan originations team of a life insurance company, bank, or debt fund this year, any rate cuts that are made in the future could result in major upticks in origination volume, which would put you right in the middle of the action whenever that uptick in activity does end up happening. Overall, there's a lot of uncertainty in the market right now, but hopefully this information is helpful as you're planning next steps in your career in 2023. And if you want to make sure you're prepared for the job search, regardless of market conditions this year, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break Into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on this channel on what's going on in the commercial real estate market right now, make sure to hit the like button and let me know. And let me know in the comments where you think interest rates and property values are going to go in 2023. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.